Imagine a financial earthquake, really shaking the foundations of American economic policy. That's pretty much what's unfolding right now at the Federal Reserve. It's a showdown so unprecedented it could redefine the central bank's independence as we know it. We're diving into a really high stakes legal and political battle. President Donald Trump has formally moved to fire Fed Governor Lisa Cook. He's citing serious allegations, things like mortgage fraud, and claiming, quote, deceitful and potentially criminal conduct. But Governor Cook, well, she isn't backing down. Nope, she's refusing to resign, getting ready to file a lawsuit. It's setting the stage for a constitutional clash. So today we'll unpack the deep historical criticisms leveled against the Fed pretty much since its birth. We'll explore this escalating drama around Governor Cook and reveal how a crucial Supreme Court ruling is kind of reshaping the power landscape. This could potentially impact your investments, and the stability of the dollar itself. Get ready to understand why the very institution designed to study our economy is now, well, right at the center of a storm.
And what's really at stake here, I think, beyond just a single governor, it's this fundamental tension, isn't it, between political influence and the Fed's mandated independence. It really raises a big question for all of us. Can a central bank truly stay immune to political pressures, especially when the economic stakes are, incredibly high? What does history tell us about that tension?
That's a crucial point, yeah. To really get where we are today, we kind of need to look back, right? Because this isn't the first time the Fed's independence has been, questioned. From its very beginning in 1913, the Federal Reserve System, or the Fed, it was always a contested compromise, a sort of tug of war between powerful bankers who wanted control and President Woodrow Wilson pushing for more public oversight. Seems like the scrutiny started almost immediately.
Oh, indeed. The Fed's design, its very structure, sparked criticism right from the outset, particularly from those, who just distrusted centralized control over the money supply. Take Milton Friedman, for example, Nobel laureate, huge figure in economics. He argued really forcefully that the Fed's policies, its restrictive policies, actually made the Great Depression worse. He even proposed, get this, replacing the Fed with a computer program to automatically manage the money supply, basically arguing that human discretion often leads to disaster.
And Friedman wasn't alone in being skeptical about government-controlled money, was he? Murray Rothbard, another really staunch critic, went even further. He called the Fed's creation of fiat money backed by nothing. He called it legalized counterfeiting. Harsh words. He believed those kinds of policies just aggravate inflation. Rothbard famously said, ever since the Fed was visited upon us in 1914, our inflations have been more intense and our depressions far deeper than ever before. He was pushing for a return to the gold standard.
Right. And this deep-seated suspicion of central bank power, it's a pretty consistent thread among certain conservative thinkers. Ron Paul, former congressman, prominent in the Tea Party movement, he's echoed these sentiments for years, consistently calling for the Fed's abolition, a return to market forces setting interest rates. He argues its policies caused these economic booms and busts. His book, End, the Fed provocatively claims the government and its banking cartel have, quote, stolen more 95 of every dollar through inflation. These aren't minor critiques. They're fundamental attacks on the institution's very integrity.
It's interesting. It wasn't just economists outside the system. Even some early supporters in Congress started raising alarms. Senator Robert Owen, one of the co-sponsors of the original Federal Reserve Act, he later felt the Fed wasn't delivering on its promises. And maybe most startling, Representative Louis T. McFadden, he was a former House Banking Committee chairman. He actually accused the Fed of deliberately causing the Great Depression, claimed it was run by Wall Street interests. These are powerful indictments suggesting a fundamental flaw, at least as some critics see it.
And if you look at the Fed's actual track record, its role in major economic crises is definitely a recurring point of contention. You mentioned the Great Depression, 1929. Friedman and Anna Schwartz argued that restrictive monetary policy made that crisis much worse. They said it allowed a mild recession to just spiral into a catastrophe by letting the money supply fall by over a third. Even former Fed Chairman Ben Bernanke later admitted, regarding the Great Depression, you're right, we did it. We're very sorry.
Wow. And it wasn't just the 1930s, right? Fast forward to the 2008 financial crisis. Again, some economists, like John B. Taylor, argue the Fed contributed to the housing bubble. How? By keeping interest rates too low after 2001. Former Senator Chris Dodd, he went as far as calling the Fed's supervisory role during that period an abysmal failure. So yeah, critics definitely have a long history of pointing fingers at the Fed during major downturns.
And beyond just its policy decisions, transparency. That's always been a major concern. Critics like Rothbard, historically, they questioned the Fed's accountability, its lack of a budget, its audit processes. Now, okay, The Fed now reports its balance sheet weekly. It undergoes audits. But the debate over transparency, especially around the FOMC, the Federal Open Market Committee meetings, that definitely continues. There was a Bloomberg poll showing a majority of Americans believe the Fed should be more accountable or maybe even abolished. So this whole historical context is really vital for understanding the current battle around Governor Cook.
Okay, so let's unpack this current challenge. It really is unprecedented, this move against Governor Cook. It kicked off with Bill Pulte, a Trump appointee, accusing her of mortgage fraud back in 2021. The specific accusation, just to be clear, is that Cook claimed two primary residences, one in Ann Arbor, Michigan, another in Atlanta, Georgia, claimed them on separate mortgage applications, potentially to get better loan terms. And look, we need to be clear for listeners, this isn't like a parking ticket. Pulte emphasizes mortgage fraud is a very serious federal crime. We're talking potentially up to 30-year prison sentences.
Yeah, and what's really notable here is the speed, the directness of President Trump's actions. August 20th, 2025, he publicly demands a resignation on social media. Then, just 5 days later, August 26th, he sends a letter. Says she's removed from her position, effective immediately. Quote, Trump cited his authority under the Constitution and the Federal Reserve Act of 1913. He stated there was sufficient reason to believe Cook made false statements on one or more mortgage agreements, and that her, quote, deceitful and potentially criminal conduct eroded confidence in her integrity and competence. Strong stuff.
But Cook isn't going quietly at all. She was appointed by President Biden in 2022, serving a 14-year term. She's flat out refusing to resign. She stated that no cause exists under the law for her removal, and that President Trump has, quote, no authority to do so. Her attorney, Abby Lowell, announced plans for a lawsuit, calling Trump's action an attempted illegal action, an authoritarian power grab, saying it lacks factual or legal basis. And the Federal Reserve itself weighed in, emphasizing that these long tenures and removal protections for governors, they serve as a vital safeguard for monetary policy.
Right, and this is where the legal precedent gets really interesting and potentially reshapes presidential power quite a bit.
Yeah.
The Federal Reserve Act of 1913 says a president can remove a Fed governor only for cause, but critically, it doesn't clearly define what adequate cause actually means. So this legal battle is, like you said, sailing into totally uncharted legal territory. No president has ever tried to fire a Fed board member before this.
And historically, there's been this bedrock case, right? Humphrey's Executor v. United States from 1935. That Supreme Court case has protected the heads of independent, multi-member agencies from presidential removal just based on policy differences. It shielded bodies with these quasi-judicial or quasi-legislative powers, basically acting almost like courts or lawmakers in specific areas from direct White House influence. For nearly a century, that's been a key safeguard.
But then came May 2025. Things shifted. A 6-3 Supreme Court supermajority granted an emergency stay in Trump v. Wilcox. Now, this effectively allowed President Trump to dismiss members of the National Labor Relations Board, NLRB, and the Merit Systems Protection Board, MSPB, without cause. That significantly weakened the Humphrey's executor precedent. It signaled a pretty clear shift towards expanding presidential control over these agencies.
Yes, but then, in a really surprising twist, the Supreme Court specifically distinguished the Fed. They carved out an exception just for it. The majority opinion stated, and I'm quoting here, the Federal Reserve is a uniquely structured quasi-private entity that follows in the distinct historical tradition of the first and second banks of the United States, basically implying its independence remains protected. It's almost like the court said, okay, you can fire these guys over here, but not those guys at the Fed, creating this very specific and, controversial loophole.
And Justice Elena Kagan, she wrote a forceful dissent criticizing this puzzle of a carve-out. She argued, look, the Fed's independence rests on the same constitutional foundations as other independent agencies. She accused the majority of making new law on the emergency docket, basically, deciding a huge constitutional question in a very hurried way. Critics are arguing this selective application points to a judicial philosophy maybe geared more toward expanding presidential control, except for doing so might create, quote, immense practical and market disruption, like with an institution like the Fed. This is really crucial for understanding where the Fed's independence might stand going forward.
Okay, so we've kind of dissected the legal maze around Cook and the huge implications of Trump v. Wilcox for the Fed's independence. But let's talk real-world stakes. What happens if this independence erodes? Just weeks before this Cook controversy blew up, another Biden-appointed Fed governor, Adriana Kugler, she abruptly resigned. August 8th, 2025. cut short a term that was supposed to run until 2026. This unexpected vacancy, well, it opened a critical door for Trump to start reshaping the board.
And Trump moved fast. He nominated Stephen Miran, who's the chairman of the President's Council of Economic Advisors, to fill Kugler's seat. Now, Miran is known as an ultra-dove, meaning he strongly favors lower interest rates, looser monetary policy. He's also the architect of this Mar-a-Lago Accord idea, think of Plaza Accord 2.0 maybe, aimed at weakening the dollar through international agreements, pressure on other nations. He's openly advocating for a 0.5% interest rate cut at the very next FOMC meeting in September.
So let's connect the dots if Moran gets confirmed. And if Cook's dismissal is ultimately upheld by the courts and Trump gets to appoint her successor, then the 7-member Board of Governors could potentially shift to a 4-3 Republican Trump-aligned majority. I mean, that could drastically shift the Fed's monetary policy towards more dovish rate-cutting actions. That's a huge potential change from the Fed's current, more moderate stance, right? Taking it away from fighting inflation, perhaps.
And this potential shift, it's happening under intense external pressure, too. Treasury Secretary Brazen has also been actively pushing the Fed for rate cuts, stating publicly that current rates are, quote, 1.5% to 1.75% too high, and arguing the Fed should start with a 0.5% cut in September. The Secretary has even scheduled individual meetings with, 11 potential next Fed chair candidates around September 1st. I mean, these actions really suggest a strong desire from the executive branch to ease the interest burden on the nation's massive $37 trillion debt and, maybe bring the Fed more in line with its economic agenda.
Which brings us to the broader economy, which is already, under immense pressure. The U.S. economy is facing stagflation right now. That's accelerating inflation, potentially driven by proposed tariffs, immigration restrictions, tax cuts, coupled with slowing economic growth. This really traps the Fed in a bind, this two-edged sword dilemma, trying to balance its dual mandate, price stability, and maximum employment. So if the Fed, now potentially more influenced politically, shifts to overly dovish policies, how does it even navigate these treacherous waters?
Well, from a more conservative perspective, the argument is that the Fed's core mission really should be maintaining the dollar's purchasing power, period. Not getting swayed by political demands for short-term economic boosts or trying to engineer employment numbers. Prioritizing price stability, that's seen as essential for long-term economic health, even if it means some short-term pain. Amidst these stagflationary pressures, a politicized Fed could really struggle to fight inflation effectively. It might end up sacrificing that core mission for, political expediency.
And compounding these issues are real concerns about market overvaluation. The U.S. stock market's Buffett indicator, that ratio of total market cap to GDP that Warren Buffett uses, it's at an abnormal 211%. That's way above the historical average of 100%, even higher than the 2000 tech bubble's peak of 140%. So if the economy is like a house, this indicator suggests the market price is just wildly higher than what the house might actually be worth. What does that mean for stability if a potentially politically influenced Fed starts pushing for even more liquidity?
And what's also concerning, perhaps, is the actual impact of AI on the economy. Look, AI's technological potential is undeniable, obviously, but some analyses suggest its actual contribution to GDP might be more limited than the hype suggests. Think about the rapid commoditization of AI, cheap, open-source alternatives popping up. That could reduce the added value from IT development, which has been a major profit source for American companies. If this trend really takes hold and eliminates a significant source of added value, well, that could challenge some foundations of capitalism itself and negatively impact GDP and stock prices down the line.
Yeah, consider this really striking statistic. NVIDIA, single semiconductor company, recently hit a market cap of $4 trillion. $4 trillion. That nearly matches the entire Japanese stock market, and it exceeds the projected 2025 GDPs of both Japan at $4.3 trillion and India at $4.1 trillion. I mean, that abnormal valuation for just one company compared to entire national economies, it raises serious questions about market stability. And whether these market prices truly reflect real-world value feels like a significant speculative component there.
Absolutely. And in the face of all these economic uncertainties, these potential shifts in monetary policy, well, investors are looking for safety. Gold prices have soared. Dollar-denominated New York gold futures were up about 22% from January to August 20th, 2025. That significantly outperforms the S&P 500's 13% rise. The All-Country World Index's 12.5% rise over the same period. This dramatic surge in gold, it suggests growing dollar distrust, maybe increased geopolitical risks. Investors are clearly seeking refuge in hard assets. It's a clear signal that something fundamental might be shifting under the surface.
Wow, we've navigated a truly complex landscape today, haven't we? From those foundational criticisms of the Fed going way back to this unprecedented legal battle over its independence right now, and the really profound implications these events hold for the global economy. The battle over Lisa Cook's position, the shifting power dynamics within the Fed, it all highlights this critical tension. Should this incredibly powerful institution remain truly independent, or will it become increasingly susceptible to political influence?
And I suppose this is where we leave you with the provocative thought to mull over. If the very body designed to keep our economic ship steady, to provide stability, if that becomes a political battleground, what does that ultimately mean for your investments, your savings, the dollar in your pocket? The future of monetary policy, of economic stability itself, really hinges on how these events unfold. It invites all of us, I think, to watch very closely and consider the potential long-term consequences of a central bank potentially losing its independence.